When engineers want to test a bridge, they don't just drive a compact car over it. They park a fleet of freight trucks on the span and, wait for a hurricane.
Right, they want to see exactly how the structure absorbs the shock.
Exactly. And welcome to today's deep dive into the July 24, 2026 Bitcoin landscape. We are on a mission today to help you unpack how escalating geopolitical shocks and looming quantum computing threats are stress testing Bitcoin's market structure in real time. Because, while crypto markets run 24/7, this past day has been uniquely turbulent.
Yeah, look at the macro pressures converging right now. We have this massive escalation in the Middle East. The U.S. has conducted 13 nights of strikes on Iranian targets, and Houthi militants have essentially blockaded the Bab el-Mandeb Strait.
Which is a huge bottleneck.
It is. That blockade has already slashed shipping traffic there by 34%, which immediately drove Brent crude oil past $100 a barrel.
And ECB President Christine Lagarde is calling the systemic inflationary pressure alarming, right?
Yeah, and because of that, the odds of a July Fed rate hike just jumped to 40%.
So the hurricane has officially arrived. Looking at the charts, the price dipped down to around $64,564 on algorithmic selling before recovering back over $65,000. But spot ETFs just logged over $225 million in outflows. That looks like institutional buyers are hitting pause. Is this resilience just a facade?
Well, no, we're actually watching two completely different market forces collide here. Those ETF outflows, that represents hot money.
Like traditional tech equity investors pulling back.
Exactly, they're pulling back as broader liquidity contracts in response to a potential rate hike. But underneath all that, the on-chain data shows massive accumulation by wallets holding between 1 and 10,000 Bitcoin. These whales are acting like anchor tenants.
So the hot retail money flees at the first sign of macro trouble, but the structural holders are just absorbing that excess supply.
Right. They view the asset as a non-sovereign hedge against fiat debasement and, supply chain weaponization. They aren't rattled by a rate hike at all. They're treating the network as a long-term structural lifeboat.
Okay, so if whales are treating this as a lifeboat, what about the legacy financial system? They can clearly see this capital flight happening, which I guess might explain why traditional banking lobby groups like the Bank Policy Institute are suddenly panicking over the Clarity Act.
Oh, absolutely. Regional banks view yield-bearing stablecoins as an existential threat right now.
Because if you can hold a stablecoin on your phone and earn a 5% yield, why wouldn't you just move your money out of your local bank account?
Exactly. And that local bank then loses the underlying foundational deposits it desperately needs to issue mortgages and small business loans. It literally drains their liquidity. But then contrast that with what we're seeing in Canada.
Right, where Netcoins just launched that regulated product.
Yeah, allowing users to collateralize their Bitcoin to unlock fiat loans. It turns a previously sterile digital asset into productive collateral.
It's just a fascinating irony. Regional banks are fighting tooth and nail to kill crypto products to save their deposits today, while Wall Street titans are simultaneously funding Bitcoin's survival for tomorrow. I'm looking at this newly formed Bitcoin Security Consortium.
Giants like BlackRock, Coinbase, and MicroStrategy.
Right. They just pledged $15 million over 3 years to protect the protocol's cryptography. But I don't fully grasp what they are defending against. What is the actual threat here?
So they are preparing for post-quantum computing. Right now, the math protecting Bitcoin, specifically the SEC-256K1 elliptic curve, works like a one-way mirror.
Okay, so anyone can see your public address, but it's mathematically impossible for current computers to reverse engineer your private key.
Exactly. But a quantum computer could theoretically look right through that one-way mirror and calculate your private keys directly from your public address.
Wow, so this massive capital injection is to make sure the network upgrades its cryptography before supercomputers actually reach that capability.
Right. Industry estimates put that threat on a multi-year horizon. But this deployment proves traditional finance no longer views Bitcoin as an experiment. They see it as permanent global infrastructure that requires a well-capitalized preemptive defense.
So to summarize what this all means for you listening, Bitcoin is absorbing massive, real-world inflationary shocks in the present, while legacy institutions are simultaneously battling over its short-term impact and deeply integrating with its long-term future.
It really is the ultimate structural stress test. And I think it leaves you with an important question to ponder.
Let's hear it.
Well, if the world's largest asset managers are already heavily financing Bitcoin's defense against quantum computers, what does that reveal about their long-term timeline for fiat currency?
Talk about looking past the hurricane. We'll leave you to think on that one.